So we're absolutely delighted to have Charles Lemonides here with us today. He founded ValueWorks with the goal to broaden availability of his conceptual value investing discipline in the retail and institutional investor communities. He leads investment research and portfolio manager at ValueWorks and has final authority for all investment decisions. His philosophy of value investing was born at the regional brokerage Guntel and Company during his tenure in Grenfell's research department, beginning in 1986. He honed skills covering risk arbitrage, the banking industry, and special situations. He notably spearheaded the addition of high-yield bonds and digital securities to the department's coverage. In 1994, he joined Sterling Advisors, an investment advisory unit of Grenfell and Company. He became chief investment officer of Sterling the following year. In 1999, he merged this internal investment practice into the independent advisory firm M&R Capital. As chief investment officer of M&R, he began branding the composites he brought over from Sterling under a ValueWorks banner, laying the ground for establishing ValueWorks as a fully independent firm in October of 2001. He received his bachelor's degree in history from Vassar College and pursued graduate studies in economics at New York universities. Thank you for joining us today, Charles.
Thank you very much for having me.
Excellent. So let's dive into the presentation.
Sure. So happy to be in front of you folks talking about what ValueWorks does and how we view the markets and what we bring to the table from an investment perspective. And, you know, the big picture for us is to talk about value conceptually as an investment discipline and what that really means. And it's important to have a firm sense of why you're pursuing an investment discipline and to understand what the discipline is conceptually before you bring it into practice. And to us, value investing simply means you start the process caring about price. That you ask yourself, what are the assets that underlie this investment, and what are they worth in the real world today, and what price am I paying to control them today when I buy a specific security? And at ValueWorks, we try to get $1 worth of assets for 50 cents, hopefully do it in places where the assets are going to be growing in value over time, so we try to avoid a value trap, and hopefully do it in places where the discount between what the assets are worth in the real world today and the price we're paying for them is going to close over time, over some specified period of time. The nice thing about that as a discipline is it doesn't tie you to a particular asset or a particular metric to determine what value is. And that allows you to build a legitimately diversified portfolio. And it takes you away from the construct of value stocks being the bottom half of valuation continuum. When Russell or any big index company decides what a value stock is, they just take the relative prices at which things are trading, and they assign a value designation to the bottom half of the valuation continuum and growth to the top half. And you know, that doesn't take into account the fact that some assets properly should have higher multiples of different metrics than other assets. And it doesn't take into account the different accounting treatment that leads assets to have the specific types of valuation metrics they have. Financial companies will always trade at relatively low prices to book value because the asset that they bring to the table is book value, and they get to earn a return on book value. A pharmaceutical company expenses all of their research and development as they go. So if they spend $2 billion or $7 billion to develop a drug, at the end of that process, they've expensed that $2 or $10 billion, so they have no book value on their balance sheet. Yet that drug could be worth, something relative to the $2 billion they invested in it, but their multiple to book value on a static basis is going to just always look high. So if you use a metric-based approach to value, you end up with companies that all have similar attributes and are not necessarily less expensive than other companies. They just have lower multiples. So, when you identify that as your framework, we try to buy good assets cheap. It sort of begs the question, and what does the other guy do? Try to overpay for crappy assets? Is value the only right investment strategy? And I don't think that that's the right conclusion. Value is not the only right investment strategy. I think there are three big schools of investment thought that all have their own inherent logic and dynamic to them. Value is one, where you start with price and say, well, what am I paying to control an asset? And I want to get it at a discount. The other big school of investment thought is growth. And I don't think it's fair to say, look, I think what growth investors are trying to do are identify the highest quality asset that is growing in value over time the best, and not worry about if they're getting it cheap or not. The rationale being that if the asset's growing and it's going to and the value is going to build over time, firstly, I'm not going to typically get the best quality assets at discounted prices. You know, you usually have to pay a lot for something that's really good. And you know, 3 years from now or 7 years from now, you know, it may still be very, very richly priced, but it'll be richly priced on a higher asset value. And so, you know, if I worry about getting it cheap, I'm going to miss the best opportunities. And I think that's a very conceptually legitimate way to look at growth. And once you identify growth and value in those sort of conceptual ways, the value guy starts with, hey, what's the stuff worth today, and can I get it for less than that? The growth guy starts the process, hey, which of the companies growing in value the best, and will they still be growing in 3 and 5 years from now? Those two are both legitimately, you know, sound, solid investment approaches. They're different, but once you identify them as those two conceptual approaches, it's impossible to say one of them does better over time than the other. There's no such thing, and there's no way to prove it or document it, etc. The third big school of investment thought is anything that takes price adjustment mechanisms into account. So generally speaking, you could say it's a technical analysis or a momentum analysis or a contrarian analysis, which is anything that says, look, prices have adjustment mechanisms. And when I make an investment decision, I don't care if this thing is cheap or expensive. I'm looking at how its price adjusts over time, and I can identify patterns in price adjustment, and I could make money off of those patterns. And you know, you hit cruise control on one car, and you get up to speed in a certain pattern. You hit cruise control on another car, you get up to speed on another pattern. Stock prices and bond prices and financial instruments have those same sorts of patterns, and if you can determine what that pattern is and read it properly, you know, it's an investment discipline. So those to me are the three big schools of investment thought. We apply a value craft because it suits our personality, it suits our skills, our comfort level with downside and risk. Because, you know, from a value perspective, when something goes wrong, that the price of the security goes against you, you know, you have to revisit your thesis and ask yourself, does the thesis still hold or not hold? And if it doesn't, you exit the investment. But if it does, you have a dollar amount that, you know, you're willing to stake a claim on and stay with the investment. A growth investor sort of has a different problem in that, you know, if they believe it's a growth stock and it's trading at X per share, and then on another day they don't believe it's a growth stock anymore, whatever price at which it's trading for makes it a bad investment. Because, you know, my discipline is it's growth, and now it's not growth. So whatever price it was and whatever price it is, doesn't matter. I was buying it when it's growth, and I'm selling it when it's not. And it sort of gives you less control over the negative case event. And so having more of that control from a value perspective is why I gravitate to value. Also, it suits our skill set in terms of the analytics and the rigor of the process. That said, you know, that's my conceptual approach to the process. Let me open my slide deck here. I'll just scroll through it. Value works, quality assets, compelling valuations. As a firm, we've been around since 2001. We launched a partnership vehicle in 2006. We have 260 million in assets. 125 million of that is in a partnership vehicle. We're not addressing value from the perspective of the bottom half of the valuation continuum. We're addressing value of anything that's giving us a dollar's worth of assets for 50 cents. Importantly, we at ValueWorks think it's important to look everywhere in the capital structure to understand the best risk reward in an investment. So look, you look at a company and it has assets that are worth, $500 million, and you see that they have debt of $400 million and an equity cap of $200 million, and you're like, well, that's not a great investment. And then you dig a little further and you see that the debt is actually trading at 50 cents on the dollar. And so when you're buying the debt, you're paying $200 million to get an asset at $500 million, and all of a sudden you have something that's interesting. Also, you look at a company that has $500 million worth of assets, you really understand the assets, and then you look at the stock and there are 10 million shares trading at $20 a share, and it's $200 million equity cap, so you're paying $200 million, $500 million worth of assets. But you didn't pay attention to the fact that there's $400 million worth of debt ahead of you, or $200 million worth of preferred stock, or litigation claims that are going to get that, or a union haggling for those assets. So you really need to understand the whole capital structure, all of the liabilities, to really understand the price you're paying. We at ValueWorks love to find stocks that are really growth stocks, but are trading at value prices. To us, that's the holy grail of what we're looking for. And when we talk about assets, it's generally speaking, it's operating businesses, but they could be cash, financial instruments. If a company has real estate on the books, interest in other businesses, you have to look at the whole spectrum. And again, you have to look at the claims against those assets. Our process is to look for stuff. That's identification, right? Like, okay, where are the interesting ideas? Then you start with saying, all right, what are these assets worth? Appraise them, assess them, go through the whole process. Are they good, bad, etc.? Once we make a decision to invest, you're monitoring and reevaluating it and asking yourself the question is everything we said on day one still true today? And one of the central investment fallacies is to take your cost basis into account when you make the decision, when you're monitoring it. Okay, these are the attributes of this investment today, and with these attributes, I think it should be bought, sold, or held. However, I bought this stock 6 years ago at X price. How does that change the attributes of this investment going forward? I bought it at $6 billion and now it's $20 billion, so I should keep it. I bought it at $20 billion and now it's $6 billion, so I should sell it because the market's telling me I was wrong. Your cost basis, how does it have predictive value? It doesn't. So if you care about understanding what the price will be tomorrow relative to the price today, why would you introduce something into that process that has no predictive value? And your cost basis, the decision you made on a Tuesday in February of 2020 and 2019 doesn't impact whether this will be worth more or less tomorrow or the next day. Oh, well, I made money, I lost money. Well, yeah, you made money, you lost money on this investment or any other investment. How does that embody predictive value? It doesn't. So why would you take it into consideration? So when we're monitoring and reevaluating, we're trying to stay with what is today, not what decisions we made yesterday or how we came to be in the investment. And when something's fairly priced, we sell it. Easiest part of our investment discipline, it's fairly priced, we sell it. When we build portfolios, it's really security specific. It's high conviction names. We believe in sectoral diversification because diversification helps. We do it with 25, 40 long positions and 5 to 10 short positions. We do that because it's the number of securities that I find that we can get enough expertise and conviction on, and provides adequate diversification, and doesn't dilute our expertise in our calls. And it gives us enough diversification in our experience. How has it worked for us? Well, for us, it's worked pretty well in some ways. We've been managing this portfolio for 25 years or something. It's earned 14.5% or so on a net basis versus 8% on the S&P. Over the past 10 years, we haven't been as big an outperformer to the S&P. We've only earned 20% versus 16%. But in a very powerful up market, we've earned very powerful rates of return. And that's been true over the past 5, 3, and 1 years as well. If you generate those types of returns, this is the kind of rate of, this is how your dollar grows over that period of time. So a dollar with us back in 1999 is $20 today versus 5 million in the Barclays or the S&P. We'll touch on one investment idea, and I'll speak about it for just a couple of minutes and then let you ask some questions. Mesabi Trust. So Mesabi Trust is a trust that derives its income from an iron ore mining operation. North Shore Mining Company mines the ore, and every quarter, depending upon how many tons of ore they take out of this mine, and depending upon the price of the ore, they pay Mesabi Trust anywhere from 3% to 7 or 8% of the value of that iron ore, and then Mesabi pays it out as a dividend. These have been the dividends Mesabi has paid for the past 20 or 15 years or so, 10 years. This has been the share price through the fall of last year. You could see it was $30 to $35 a share. The company was paying something like $1 per quarter in dividends, so it was a pretty attractive yield. And it was considered really well positioned because the price of iron ore has been going up. Iron ore is in short supply. And, all the fundamental dynamics are positive and for you. Then on a conference call back in October, the CEO of Cleveland Cliffs, which owns the North Shore mine, said, basically, we're going to start moving our production from one of these mines to another so we don't have to deal with the unreasonable royalty structure of Mesabi. Mesabi Trust was $35 a share right around then. It was down to $20 within a week. On the notion that they're going to stop mining this thing. Well, will they stop mining this thing? They haven't stopped mining this thing. These are the ships that have left there from then till now. This is how the shares rebounded through beginning of January, and then they came out again and announced in their next quarterly results that they're going to stop mining from this facility in the springtime and resume mining later. The stock subsequently came down to around $22 a share. Why do we like this stock at $22 a share? Well, there are 14 million shares outstanding, so at 22 you're paying just $280 million. And what you get here is a dividend stream, an income stream based on how many tons of iron ore they mine and the rate. And right now, people think, well, geez, maybe they'll stop mining there. The problem with that is it doesn't make any sense. And so you ask yourself, what is different today than yesterday and the day before? And one thing that's different is back in October, an arbitration panel came out with a decision on how Mesabi and North Shore should figure the price of iron ore coming out of the mine. That agreement dates from 40, 60 years ago. North Shore and Mesabi have been feeling each. Mesabi had the perspective that North Shore and Cliffs were not determining the average price properly, the price of iron ore properly, and they asked for an arbitration about that. The arbitrators came out and said Mesabi should get an extra couple of $1 million because they had undercounted the price. And then the arbitrators went a step further and they said, well, instead of using the average price, North Shore needs to use the highest price they received for any of their cargoes over any 12-month period. That changes the economics of this investment dramatically to the good for Mesabi Trust. Because what just happened is you had an asset and it got a decision saying that asset should be worth more money. The party on the other side said, geez, I don't want to pay more money. So I'm going to haggle and complain and bitch and say, I'm not going to pay it. And so Cliffs has come out and said, I'm not going to pay it. We're not going to use it. But the mine is worth money. And why do we think the mine is worth money? Because year in and year out for the past 40 years, they've mined roughly 4 million tons of iron ore from that mine. When economic times are good, a little less. When they're bad, when they're good, a little more. When they're bad, a little less. Right now, economic times are good. And the demand for U.S. iron ore is sky high. And that's evidenced by the fact that iron ore prices today are $150 a ton. And they've been as low as $40 or $50 a ton. And you can't get enough iron ore out of the ranges to feed all the steel mills that are out there. And they're building more of them. And it costs more money to bring the iron ore from Australia up the Great Lakes and around and feed the steel mills that are in the U.S. And they're going to mine probably something like 4 million tons. Now, the CEO of Cliff said, we're going to move that production to another mine up the river, up the lake. That other mine has mined roughly 2 million tons of iron ore for the past 30 years. It doesn't have the capacity to mine 4 million tons. Cliffs has invested $100+ million in the North Shore mine over the past couple of years because it's a good mine, because it's a low-cost resource, because it's iron ore that should be mined. Cliffs could choose not to mine the iron ore, and then they would not sell 4 million tons worth of iron ore from the North Shore resource, and they would not get $150 a ton for that iron ore, and they would forego getting $600 million. And they could make that choice in order to save the 7% average royalty they're going to pay on that $600 million. So they could choose not to collect $600 million because it's uneconomic for them if they have to pay out $60 or $40 million worth of dividends. But it was economic for them to mine iron ore when iron ore was $60 a ton. It's $150 a ton now. So they would be, choosing not to get $200, $300 million net income to them for the benefit of someone else not getting $60 million of net income to them. That doesn't make any sense. So we think there's an asset there. We think that asset is worth something like, $500 to $1 billion because of that dividend stream. And we surely think if inflation happens, the price of iron ore goes up over time. And we think if the economy continues to grow, you use more steel in the U.S., not less. And so our approach is to say, look, the asset is worth this. This is the price we're paying for it. This is why we think the asset has real value, and that value will grow over time. And now the price is at half or less of what we think that asset is worth. So that's the conceptual approach. I've spoken for 7 minutes longer than I said I would. So now let me turn it over to you for a little open discussion.
Yeah, absolutely. That sounds really great. And thank you as well for that presentation. It was really excellent. For our first question, can you talk about how you originally got interested in investing and specifically in value investing?
I think that the difference, but I think that it's an important undertaking for people to do. I think capital allocation matters. I think smooth functioning financial markets matter. So my starting place was that I think it's sort of a high value add thing to do for the world. I think it matters. I think it makes people's lives better. I think it's what makes, you know, our lifestyles possible. And I thought that I would have a skill set that was well suited to it. And so, you know, seemed as the best fit I could find for my skill set and what I cared about.
Yeah, absolutely. And can you talk a little bit about your views on oil in general and also on your thesis for Mammoth Energy, please?
Sure. So oil is obviously a really interesting and timely discussion right now. One of the most economic places to produce oil is, of course, the Soviet Union. They have a very, very abundant resource, and it's really cheap to get it out of the ground and cheap to get it to market. And they've been a major supplier. That supply is going to be under pressure for quite a while, given what's happening in the world. And so, you know, there's going to be ample demand for oil in the near term. Longer term, you know, hopefully we'll rely less on oil and hopefully we'll be burning less carbon and hopefully, you know, overall pollution going into the atmosphere, greenhouse gas and other goes down. And hopefully we do that in a way that allows us to continue to grow our economies and live reasonably well in the meantime. So with those things in play, you know, I think oil is likely to be really profitable to drill and produce in the U.S. and the West for, you know, the reasonably near future. And over the past couple of years, you know, the valuations on energy companies have really become very, very, very compressed because on the one hand, their business dynamics were challenged for the better part of the past decade. And on the other hand, people are thinking that we're going to go to a green future. And you know, I do hope we go to a green future, and I hope we use less oil in the future. And I'm happy to have spent money on an electric car instead of a gas-burning car. But until we all get there, there's going to be work to be done delivering energy to people. And the valuations on many energy stocks are just really, really attractive today. Mammoth is a small one, and it's got a very particular investment dynamic because it's $100 million equity cap and roughly $80 million worth of debt. And they are owed about $250 million that we think they'll get from the government of Puerto Rico for work that they did there. And then above and beyond that, they have a fleet of fracking equipment that's probably worth another couple $100 million. And their business is probably at a good inflection point.
Yeah, absolutely. That's very interesting. Thank you for sharing that with us. And can you speak a little bit more about how you analyze management, please?
Well, look, we talk about our process being identify a dollar's worth of assets, find places where they're growing in value over time. If you have a management that is a good steward of assets and executes well, you know, they have a better shot of growing those assets over time. If you have a terrible management that is not growing assets over time, then you're at danger of being in a value trap. And frankly, you know, in the case of Mammoth, we're at danger of being in a value trap. We just expect management to make the decision to exit the business entirely over the next couple of years. And therefore, the fact that management has not been effective is something we're willing to hope works itself out in a better way.
Yeah, absolutely. We've spoken on oil, we've spoken about iron. Are there any other commodities, whether they're metals, agricultural commodities, other energy commodities, that seem to you to be an attractive setup and that you're investing in?
So in the energy space, there are a bunch of very, very attractive assets. We own Tidewater, which owns a fleet of vessels that run back and forth supplying the offshore drilling fleet. And they're starting to move into offshore wind support as well, which is going to be a very dynamic and growing business for a long time. We own Valaris that drills for oil and gas offshore all around the world. And the valuations in some of these companies, because of the turmoil of the past couple of years, are still exceedingly compelling. But beyond that, we also own a handful of companies in the financial services business, including Genworth, which is an insurance company trading at a very significant discount, and we think they're going to finish a restructuring there over the next couple of years. We own Invesco, which their basic asset is that they manage, a huge pool of money, and they charge, 50 basis points of a fee for that. And having that money that they manage and generating that fee is an asset that they have that's worth money, and they're trading at single-digit earnings multiples. And then we own a couple of technology stocks, including Micron Technology, which, they are the dominant memory producer in the world. We own Qualcomm, which is still attractively priced and is going to generate revenues and cash flow from the 5G rollout for the next decade. And so it's not just about commodities, but all sorts of different assets.
Absolutely, I think that makes a lot of sense. And what is your advice for, let's say, students who one day maybe aspire to start a fund or to start an asset management company, knowing when is the right time to start your own fund or company and or financial company, and how you raise that initial capital?
Look, it doesn't matter. It doesn't matter when you make it your own business or whether you work for a big company. There's something to be said for starting on day one out of college with your own business and your own $100,000 or $50,000 and having a very long track record by the time you're 50. There's nothing wrong with working for, a major corporation and working for them until you're 50 years old and starting your own business with $2 billion. There's a lot to be said for learning from others. And it's a lot easier to learn from others when you work within an organization that has others in it doing the same stuff. So I think one mistake you can make is the surety that you know so much and are so well prepared that you're going to do it on your own at any given moment in time. You partner with other people when you work for an organization. You partner with other people when you build your own company. And I wouldn't underestimate how valuable it is to learn from others, because the thing you don't know when you're starting out or doing anything is what you don't know. And you can be sure you have all the answers at 22, but my experience is that every investment I've made through the first half of my career, for sure, had a pretty important mistake in the thinking that I discovered later. And there was like nuance and there was details that I didn't know. And it's probably so, and for sure it's happening to me now, because now I'm like not current anymore. Now I'm like an old person that does not up to speed with new technology. So, it's nice to have others around you could learn from. And it doesn't really matter how much money you're managing to make it work for you.
Yeah, absolutely. I think that's really great advice, and that makes a lot of sense. Can you maybe bring up 2 case studies of investments that you've made in the past? One where your thesis played out and the investment was successful, and another where your thesis didn't play out and the investment ended up being a failure.
Well, one good old one was Apple Computer in the late 1990s. In the late 1990s, technology stocks started taking off, but Apple Computer did not. It was perceived as an also-ran. It was perceived as a business that was dying. It was perceived as having lost the competition to Microsoft. But they had a new CEO come back, this fellow Jobs, who was running the company for about a year and a half when we stepped into it. And he had introduced a new product portfolio. And that product portfolio really simplified buying a computer for people. And when we stepped into it, the stock was trading at net working capital. And there was a time when Warren Buffett said, well, geez, I don't buy technology companies because I don't understand technology. And I was like, well, I don't think Apple is a technology company. I think it's more of a consumer products company. They have a consumer product that is capturing people's attention, and it's trading at net working capital. We made that investment. We held it for about 4 years until the company became a tremendous investor darling, and we sold it at about 4 times our cost basis. So that's the one that I am describing as the investment that worked out really, really badly for us, because it went up to go from there to go up tenfold over the next 20 years, and was the best investment you could have held from the moment we sold it. The moment we sold it, it was clearly trading at a premium to what the assets were worth at that time. And they were brilliant, and they grew those assets dramatically over the ensuing 20 years. And so, that's going to be my investment that worked out as an example for you, and that didn't work out as an example for you.
Sounds great. Very interesting approach. Thank you for that. And maybe speak a little bit about how important you think a MBA or a CFA is in the investment management industry, and particularly in regards to value investing.
Look, I think knowledge is what's important. I think understanding and having a very broad expertise are very important. And I think you get that by sitting in MBA classes, and I think you get that from studying for a CFA exam. And I don't think it's having a CFA that's important or having an MBA that's important. I think it's all the information and all the knowledge you get in order to get a CFA or an MBA. And, I think a CFA is a silly thing not to get, because, what it costs you is the need to generate this huge knowledge base. And the price of books, and 3 or 5 or 7 days worth of exams over the course of 3 or 7 years, depending upon how quickly you get through it. An MBA is a nice thing to have, and it's surely a normal career path. And and once you have it, it never gets taken away from you. Of course, it's a little bit more costly in terms of time and money, and alternate, and choices you could be making during that period of time. But education is always a good investment. So, there's no reason not to have, you need the knowledge. You might as well get it in school if you can.
Yeah, absolutely. I think that makes a lot of sense. And how useful do you find screeners in your process, whether they be keyword screeners that search through filings and through web results, or whether they be more quantitative mechanical screeners?
Whenever you think about two investments versus each other, you functionally have a screen. So every investment decision is sort of the result of a screen. Even when we talk about Masabi, as a standalone thing, you have to look at the other companies out there that are sort of like it. Screens can be dangerous, though, and they're a way to start identifying what the alternative investments are and how your investment stacks up to those from a price perspective. But a good cautionary tale for screens is that when we first invested in Masabi, there was another company out there called Great Northern Iron Ore that screened cheaper. It was cheaper by every metric. They were right up the road from Masabi. They were same quality iron ore, and by all the metrics, it was just less expensive. Not by that much, but by a little. The difference was both companies were formed through a trust agreement where a bunch of people were named on a trust document, and in each case, something was going to happen when all of those people died, or 35 years after all of those people died. In the case of Great Northern, it was literally 35 years after this list of people were all dead. Then they would give the trust assets back to the person who originally put it in there, which was then going to be ConocoPhillips, and it was going to disappear into nothing. In the case of Masabi, there were 35 people, and and once they all died, the trust was going to get its own stuff back. In the case of Great Northern Iron Ore, all the people were dead for 32 years. In the case of Mesabi, all the people were still alive. So in the case of Great Northern Iron Ore, your primary asset was going to go away in 3 years. In the case of Mesabi, you were going to have that asset for a long, long time to come. That data point doesn't come out in a screen. You're not going to find like that sort of really important detail when you do a screen. So a screen is a fine, part of what you do, but it's just the starting place.
Yeah, absolutely. I think that makes a lot of sense. And are there any industries that you feel are outside of your circle of competence? You don't really invest in those?
Yeah, tons of them, but that doesn't mean they will be tomorrow or the next day. And there are industries that I don't know anything about. I don't know a lot about the crypto industry, but I bet you it's important 10 years from now, and it's probably a good idea that I learn a little bit about it sooner rather than later, because I read something in the early 1990s that the internet was going to change the world, and I was like, yeah, I don't know anything about the internet, guys. But it became sort of important to learn a little bit about it because we're having a podcast because it changed the world.
For a concluding question, what are the most influential events of your investing career?
The most influential events? Sell-offs are always influential. The first one I went through was the 1987 market crash. Then the market meltdown of 1991. Then the long-term credit meltdown. Then the bear market of 2000, 2002. The great financial crisis, COVID. The important events are the ones where things go against your investment portfolio, because that's where the hard part comes in. What do you do in periods of challenge and stress, and how do you navigate that? And how do you come out the other side? Much, much, much more harder and more important and telling than what you do when the wind's at your back and your portfolio is catching fire.
Yep, excellent. Thank you so much. This is a really great session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
My pleasure. Thank you very much for having me.
Excellent. Have a great day.
Thanks, you too. Bye.